It's been a really interesting year last year with varying price actions in the market. So the clear winners were commodities like gold, obviously driven by inflation and political instability, things like uranium, security of supply.
Gold finished last year on a high, rising almost 15% during the year, defying expectations in a high interest rate environment. Gold's positive performance was linked to a combination of factors: strong central bank, robust retail demand in key markets, and increased geopolitical risk. As the margin gap between the price and the cost curve widens, we have seen our gold clients take the opportunity to enhance portfolios through M&A activity, more focus on exploration or organic growth and brownfields project delivery, and other clients choose to diversify portfolios into metals such as copper. The mid and smaller tier clients are locking in the price through derivative structures.
What came as a complete surprise to us was the sort of price action on some of the commodities which are critical to the energy transition. Things like lithium or cobalt, nickel, for example. The price performance on those has actually been disappointing, with lithium prices off almost 70% for the year. Cobalt prices have halved, and nickel prices really haven't responded to the importance one would ascribe. Other commodities that really struggled throughout the year, and so towards the end of the year you found the PGM complex becoming significantly softer, and that diamonds, and we're expecting our clients in those sectors to struggle a little bit this year after having a fabulous 4 or 5 year run into that period.
Over the last 5 years, the platinum group metals sector has experienced a high price environment. This enabled companies to put restructuring plans on hold, generate cash, strengthen balance sheets, and pay dividends. This has actually placed them in a position of strength to face the current low price environment that the sector faces. Recessionary fears in the US and Europe, battery electric vehicle uptake, substitution, and uncertainty around the timing of the emergence of the green hydrogen economy have all contributed to limited demand pull.
I think what we did see in Zambia was the sale of one asset. Interesting for us was money coming out of the Middle East, so totally new entrant into the mining sector. And then also the settlement of a dispute between one of the large operators and the government. And so, between those two, I think we've seen an improved political situation has led to improved production in Zambia.
This year, in almost all of the corporate activity, we've seen real participation from Middle East players, and I expect that to accelerate going forward as well. The other new players are things like contractors. Contractors themselves are moving into that ownership part of the value chain, and that makes complete sense, particularly if you have a skill at something like underground mining, and that underground mining potentially differentiates you from some of the producers today who are effectively outsourcing that, and there's a skill shortage. So we've seen contractors getting actively involved in the purchase of assets, and a recent example of that is JCHX buying Lubambe in Zambia. I think those banks that are physically present in these markets are going to have a differentiated product.
What we did see was also the sale of Botswana's first copper mine last year, and that was sold to one of the large Chinese SOEs that we haven't seen any investment activity from for a number of years. And we will obviously watch that process closely as the asset is transferred and those operators take control of it. I think what we also saw last year was a lot of exploration happening, both in both Zambia, DRC, but then of interest to ourselves was both in Namibia and Angola, and again continued in exploration and development in Botswana as well.
Some of you would remember last year we were talking about carbon-intensive producers, things like coal mines, diversifying their portfolios and potentially looking at other assets, things like copper or lithium or cobalt. And we've certainly seen that, but in addition to that we've seen some other changes. The first change I'd say is a broadening of what people consider to be important or strategic. So it used to be critical minerals for energy transition. Today many people are talking about strategic minerals, and therefore you include things that help develop infrastructure, so things like iron ore, aluminium and such likes. And so there's definitely a diversification of product range of what companies and countries feel are critical to the development of their economies.
Our Chinese clients have shown significant interest, especially in the West African gold region, both for operational and greenfields developing assets.
So the market is getting crowded. In addition to that, you're getting the Chinese having returned. Minmetals haven't done a trade in the international market for many, many years. And suddenly we see them participate and effectively win the bid for the assets, the Khoemacau assets in Botswana. So a real change in terms of active participants looking at these assets, and that's changed valuation expectations. And so when we've been involved in these processes, we've seen very divergent valuation metrics that people are using.
An interesting trend that we've seen in the last few years in the mining supplier space is that geopolitics is playing a much bigger role in how mining equipment and services are being sold into Africa and how they are financed.
The outlook for 2024 remains uncertain, and we expect the heightened geopolitical risk to remain as a result of the wars and many countries holding general elections this year.
Across the continent, almost every country, we're seeing increased complexity of the regulatory environment. And that, I suppose, if one looks at these governments, they're struggling a little from a stability or a finance perspective, and that puts pressure on them to put in new rules around taxation, keeping certain parts of sales proceeds in country. All of this trying to encourage the local domestic economy.
The regulatory landscape across the continent is becoming increasingly complex, especially in countries where the mining sector provides a stable inflow of foreign currency. Because of our on-the-ground presence and experience, we can provide support and appropriate advice that sets us apart from many of our competitors. We understand commodities and support our clients through the cycle.
The energy transition is driving demand for mining equipment and services. And we're also seeing recently that there is a lot more competition between the different regions of manufacturing, so Europe, North America, Asia.
Many of our clients are at the forefront of sustainability initiatives, and we are very pleased to be supporting several of them as they look to put in renewable energy to diversify their energy source and move to a more sustainable and clean future.
So we're working with our mining supplier clients and their customers to tap into this source of finance. And it's been particularly beneficial when it comes to the smaller players, such as the junior mining companies and the smaller mining contractors, which otherwise wouldn't be as bankable. So this is the great opportunity that we're looking to tap into going forward. One of the things that distinguishes our mining supplier clients from the mining companies is that they tend to have a much broader footprint in Africa. Whereas the mining companies are often concentrated in certain countries where their respective commodities are being produced, the mining suppliers really tend to operate across the continent, either directly through their subsidiaries or through the dealers through which they sell equipment. What this means is I think they really appreciate the fact that Standard Bank has got such a strong footprint in Africa across 20 countries. And this means that we can supply them with working capital finance locally, foreign exchange. We have a good understanding of the markets in which they operate. And most importantly, it means that a lot of the time, the customers that they sell to are also clients of Standard Bank, and that's a great synergy.
Logistics in 2023 on the African continent has proved particularly troublesome. If you think of the South African context, it's probably impacted the bulk commodity producers the most. Think about coal, manganese, chrome, iron ore. These guys really need to rail commodities down to ports and then for export. The troubles at Transnet has meant that, for example, coal has only been able to rail about half of what they were able to do 3 or 4 years ago. Whereas a year ago, 80% of transportation for chrome went via rail down to the port of Durban. Today, about 80% goes by road out to Maputo. But the question is always, will prices remain supportive of that sort of supply chain? We expect there will be capital that will be needed to be attracted into that sector, the infrastructure sector. And we think it's going to be a little bit like decentralized energy. We think it will happen. Private capital will be crowded in, and the very thing that is a disadvantage today effectively, hopefully, becomes an opportunity for us going forward.
I think one issue that we continue to see playing havoc on development and production in all of those regions has been infrastructure. If we consider that most of the metal that's moved is trucked, and so what we have seen is a significant shift away from the South African ports to Angola, to Walvis Bay in Namibia, back up to Tanzania, and then into Mozambique. If we come further south and we look at the bulk sector, I think what we do see is that a number of the big producers have cut back on their production forecasts towards the end of last year, and we see that maintaining this year, and that largely has to do with lack of available infrastructure, particularly on rail. And I think what we'll see is more private money entering that, and hopefully we see this year some improvements on rail in South Africa.
All of these logistics issues actually are problematic for clients because it ties up working capital. And so every day something is delayed in a high interest environment, it's effectively money spent. So they're looking to us for efficiency of product, efficiency of licenses inside of the markets in which we operate.